There only one student absent, and then I think is sister lah. She already told me. So I assume today is everyone is here, and basically I also do the recording. So my future plan is what? Okay, since you guys are my personal student, so in the future plan, meaning on the next month, what I'm going to do is the basic four classes. For sure, we will go. We will like conduct like as usual. Okay, but I will conduct another class, which means is the 3 hours classes. That one is the final exam boost camp, something like that. Normally, why is 3 hours? Let me explain to you. Because 3 hours is the examination time, and then for each of the hour, I will make sure you can complete the question within the 30 minutes. So actually, the that 3 hours boost camp is very effective because it's not the first time I do it. So normally it's the 4 plus 1. Okay, 4 plus 1. So plus one, that one is the 3 hour classes. I will free 1 more hour to you. That is what I will do to my student before this lah. But this is based on your willingness. If each of you are willing to join, then I will spare a time for you. But if you guys only want to complete the remaining 4 classes in June, so that's okay. So I will leave the time for my other class student. So how about the fee? The fee normally is the 60 ringgit. Normally is the basic, right? So you only need to add up 20 ringgit. So this 20 ringgit, what you will get is you will get one extra class with the 3 hours, total 3 hours. And then the what is the content? The content is the what? The examination question. And then I need to ensure each of you can finish each of the question within 30 minutes. So basically that is the main point. So you can consider it lah. I will get the confirmation from each of you, maybe I think on the next face-to-face classes during Monday. Okay, so that's all I want to tell you. So we continue to our class. So like what I say, before this, I think already taught you some about some content about the capital budgeting. But today, what I'm going to do is I want to show you some of the extra question. Okay, especially for the what? Especially okay. So for your information, this is one type of the question. Okay. So you see, um, AAI is a company. Okay. Project meaning forecast expected. Okay. Unit sales for a new seven voice emulation implant as for the following by the information lah. So for your information, you see totally what is the useful life? Okay, what is the useful life? Normally is 5 years. Okay, normally we'll give you the 5 years lah. So this is the 5 years project. So this is the unit not the price. So for the first years is 73, and then continually you will get the 67,000. So you see why I want to show you this question, because the recovery, listen carefully, because the recovery of the NOWC, net operating working capital, is very difficult. Okay, I will show you later on. So production of the implant will require what? 1.5 million in the net working capital. Meaning that, what is the meaning of the net working capital? If you accept this new project, you need the extra money accounted for 1.5 million in order to ensure your daily operation can go very smooth. So investment okay, each year, listen carefully each year equal to 50% of the projected sales increase for the following years. What is the meaning? Meaning that you are going to recover 50% of what? 50% of the projected sales increase. So you starting to collect back your to recover your NOWC bit by bit. Meaning is the 50% of the projected sales increase for the next year. Let's say right now is the year one, so this is the year two. So let's say here is 5,000, here is 10,000. So the difference between the both of them is what? 5,000. This is the projected sales increase, meaning that your sales is increased by 5,000. So this 5,000 you will recover 15%. So meaning that only 15% out of the 5,000 you will recover the what? The NOWC. This is very hard. Okay, I will show you how to do it later on. So the total fixed costs are the 3.2 million. So I think this one is very easy, 3.2 million. And then the variable production cost are what? And then the variable production cost is 255 per unit. This is the VC. So I hope you can jot it down right now. VC. This is the VC. And then the unit are priced at the $775. So basically, this is the selling price. Just now is the what? Is the VC, variable cost. The equipment needed to begin production has an install cost of the 16.5 million. So this is the install cost. This is the install cost. Okay. So normally this is the cost for the new equipment. You can assume like that. Okay, because the implant are intended for professional singers. This equipment is considered industrial machinery and thus qualify as 7-year MSCIS. So what is the meaning of the MSCIS? Is the second method that you should know that you already learned before. This is one of the depreciation method. Okay, so in the 5 years, this equipment can be sold for about 20% of its acquisition cost. So what is the acquisition cost? If you already look overall of the question just give you the what? Just give you the 16.5 million. So you just take the 16.5 million. Okay, so meaning this 20% of its acquisition cost. This is the what? Can be sold. So meaning this is the market value. Remember, I want to remind you again, salvage value is not equal to the market value. Salvage value is the remaining value. Sometimes even though you have this kind of the salvage value, let's say like 5k, but sometimes the question will give you the market value 10k. In this case, is when there is no book value. You get what I mean? If there is no book value. But normally, the case will be what? If the question will give you the salvage value, it will not mention the market value. The question will mention either one. Because normally, like in your syllabus, most of the question, salvage value will equal to the market value. Because the question will not confuse the student. And then the book value is the what? Is the remaining value that you record in your account. That's the meaning of the book value. Okay, I don't want to make the thing difficult lah. So that's what I want to tell you. So for you continue so it's 21% marginal tax bracket. So the tax rate is the 21, and then the required return of the project is the 18%. So based on this preliminary project estimates, so what is the NPV of the project? What is the IR? Is it you want to accept or reject it? Okay. So I hope you already very clear. So now what you need to do is what? Okay, so basically I will explain to you bit by bit. So for this AAI question, you need to do like this from the year 0 to the year 1 until the year 5. So basically, some of you maybe were confused. Hey, what is the difference between the year zero and year one? What's the meaning like year zero and year one? Normally, in the based on the finance context, year zero meaning that this is the year you are going to spend out. You are going to do the investment. So when the year zero normally for us based on the finance context is what is the cash outflow. So year one meaning that is the first year that you starting to what to gain the profit. That is the cash flow. Okay, so this is the difference between the year zero and year one. So you see the initial cost, or maybe you can say like the new equipment installation cost, whatever. So you put the 16.5 million, 16.5 million with a negative, because negative is showing that I need to spend. Okay, this is not a cash out, this is not the cash inflow, this is the cash outflow. So same thing, go for the NWC, net working capital. Net working capital is what? 1.5 million. So this is the total outflow. Listen carefully. This is the total outflow. Happen during the year zero. Okay, next. Once you already settle for the year zero, we starting to get the year one. Okay, normally, if I'm not mistaken, during the IFM, we are not going to include this one. But actually, you can do it. Okay, you can do it. Okay, it doesn't affect anything. So you see, go to the sales revenue. Okay, how I get this figure? It's very simple, because I already you see price per unit. So this is the sales revenue. You use the total how many unit? Total is 73,000 multiple with the 375. So totally you will get this number. This one multiple this one, and then you get this one. So you do the same thing for each of the different year and different sales unit. Okay, so I think this one is very simple. So I continue. So you put all the figure down lah. Okay, so now you go to the VC, variable cost. You do the same thing. Variable cost, you get the price per unit, and then you multiple with the unit of the each year. So you will get the variable cost for the year one until the year five. Okay, you do the same thing. You put it. So now sales and variable cost we settle. Now we go to the fixed cost. The fixed cost is what? Fixed cost. So normally it will remain unchanged for each of the year. So you just put the 3.2 million. Okay, 3.2 million. Now for the depreciation, the question already mentioned. The depreciation is what? The depreciation is by using the what? MACRS. So by using the MACRS, even though this is the 5 years project, but it doesn't mean that you always need to referring to the 5 years MACRS. You need to depend the question. Okay, so since the question already mentioned like 7 years, so this is the percentage. I already changed it into decimal. Don't worry, this figure will given by the question. The question will give you a table, okay, give you a table, and then mention, okay, the depreciation rate for the first year is 14.333 percentage. So when you change into decimal, I normally take the 3 decimal places. Okay, so you do the same thing for each of the year. You're trying to find all the depreciation value for each of the year. Okay, let's say you do for the year one, you use the 0.143 multiple with the 16.5. Why is 16.5? Because this 16.5 is what? Is the TDA. Remember what is the TDA? Total depreciable asset that you already learned from the IFM. So this is the total value of the asset will be depreciated. So this is the depreciation value for the year one. This is the depreciation value for the year two. And then All these are you just do the same thing lah. Okay. So lastly, the interesting is what? The interesting point is what? If you are using the MACRS depreciation method, if you already calculate up to the year end, actually, after the year end, there is no more book value because for the MSCRS, normally at the end of the project life, let's say because right now is the five, right? We only up to here, meaning that we still have some of the book value because we still have the year 6, year 7, and also year end. But if let's say the project life is up to the year end, so up to the year end you will not have any book value anymore because we assume this machine or maybe this new equipment already fully depreciated. This is the main difference between the straight line method and also MARCS. MACRS actually is MACRS. Okay, I do hope you really understand what I'm talking about. So you get the figure from the year 1 up to the year 5. Okay, you see all this figure you put over here. Okay, you put all the figure over here. So you will get the earning before interest and tax. You will get the earning before interest and tax. Okay, so this is all the earn EBIT lah. Okay, I make it simple for you. EBIT. Now you need to deduct the tax. Okay, the tax is the 21% out of the 3.2 million something. You do the same thing and then you will find the same tax value for each of the year. And after that, you use the EBIT, deduct the 21% of the tax, and then you will get the earning after tax, or maybe is the profit after tax. All this formula you should very familiar already lah. Okay, and then don't forget this is the cash flow. We are not focusing on the earning the earning after tax, something like that. So you need to add back the what? You need to add back the depreciation. You need to add back the depreciation. Okay, so the what's the meaning like add back? So you just take this amount, you see, the amount over here, you put here, tambah balik saja. Okay, tambah balik. Okay, wait, let me change something over here. MACRS, and basically, sorry, annual operating cash flow. Okay, so you see, when you add back the depreciation, you will get this amount. Sorry, you will get this amount. Okay, so after that, you are going to the second phase, meaning that you need to recover your NWC. Remember recovery of the NWC, but this time it's not in that easier way. In that easier way. Okay, like what I said, you are going to recover year by year, each year, bit by bit. Okay, meaning it's the 50% of the projected sales increase. What is the meaning? Listen carefully. So starting from the year 1, you see year 1. Okay, year 1. Okay, how I get this amount? Why is negative? You see, you use the common sense. You use the common sense first. You see, for this year, the sales is 2.7 million something. Am I right? 2.7 something. However, on the following years, on the second year, on the next year, the sales did increase from the 2.7 million up to the 3.2 million. Sorry, it's from the 27 million up to the 33 million something. So Now the sales already increased. Am I right? So just answer me is in a very common sense way. If today you're not going to increase your inventory, let's say you are not spending and then you buy more inventory in order for you to sell it and get the money, will you increase the sales? I don't think so. So when you increase your sales revenue, meaning that you need to spend. Am I right? You need to spend in order to increase your sales revenue. I repeat my sentence again. You today you need to spend the money in order to increase your inventory because the inventory is one of the asset. When the inventory is over there, then you can sell the inventory and then you can increase the sales revenue. Am I right? Common sense. So you need to spend, but spend how much? You use this, okay, to deduct this one, or maybe you want to use the this one blue color to deduct the 32 million, and then you multiple with the 0.15. Why is 0.15? Because this is the 15%. 15%. Okay, so you will get this figure. I want each of you try now. I give you 10 seconds. Can you get this figure or not? I wait for you. Okay, 10 seconds. Try. Okay, I want each of you try. If you cannot get the answer, do let me know. Okay, since there's no question, so I assume each of you understand. Now I continue. So now you go to the next year. Okay, how I get this figure? Same thing. You see, from the 32 million of the sales revenue, you able to increase up to a higher level, up to a higher sales revenue. Meaning from the 32 million up to the 39 million. Okay, up to the 39 million. So same thing, same common sense. Today you need to spend. From this year, you need to spend. You need to spend in order to increase the sales revenue on the next year. Okay, so you see, you use the in front to deduct the behind one. So we know the difference is the money we have to spend in order for us to increase the inventory, and then we have the enough and maybe like extra inventory to sell it, and then we can increase our sales revenue. Okay, so the interesting point is over here. Up to the third year, why this is the positive inflow? Because you see, the sales revenue is starting to decrease, meaning that starting from the third year, you are not going to increase your inventory anymore. You are satisfied. That's why when you are satisfied, you are not going to spend the money in order to buy more raw material, more asset, or maybe like more inventory in order for you to sell in the fourth year. So you see, on the next year, the sales is decreasing. So you use the 39 million to deduct the 36 million and then multiple with the 0.15, meaning 50%. So you will have this figure. So same thing for this one. Same thing for this one. Why is the positive? Because the sales already decreased. So same scenario. So this one is you use the 36 million to deduct the 25 million, and then you will get this figure lah. So last one, how you get this figure? How you get this figure? Remember, initially this is the negative one. Negative one, right? So you use this negative this one, meaning this one minus this one, because this is minus. It's not like minus become positive. No, it's like this negative, you deduct this one, and then you deduct this one, and then you plus this one, and then you plus this one. So the remaining you will recover in the final year. I want each of you try. Okay, Juba, each of you have to try. If you can get the answer, do let me know. Then I will proceed. Then I will continue. Boleh dapat tak? One, two, three, four, five. One, two, three, four, five, six, seven, eight, nine, 10, 11. Okay, boleh dapat. Can ah? You should get the 1162500. Okay? So for sure the symbol is negative, but you cannot put the negative because you assume you will recover this amount of the money at the end. So we assume this is the cash inflow. When this is the cash inflow, then when you total out, you able to recover the 1.5 million at the end of the project. But it's not in the total amount, it's like bit by bit. 50% in the each year. Okay, I continue. Okay, so once you already get this one, we go to the second part is the salvage value, meaning normally it's like the after tax proceed. So this for this part I already make it more in a simple in the more detailed way. But normally what you have done in the IFM is what? Okay, normally the formula is what? MV. You will get the MV, and then you need to what? You need to get the BV, and then you have to determine gain or loss. Am I right? And then the tax. Lastly, you will get the after tax proceed. So, what is the market value? When you look at the question, what is the market value? 20% of what? 20% of the 16.5 million, right? I don't know what's going on. Okay, you try to get the figure. Multiple. Don't know why. Okay, never mind. So basically, normally the market value you should get is something like uh 3 3 3.3 million if I'm not mistaken. Okay, I want each of you try okay. So see, I already write down here the salvage value is the 16.5 million multiple with the 20%. So you will get the what? 33. Sorry, it's 3.3 million. So how to get the this one? What is the this one? What is this one? Okay, I show you. What is the book value first? Book value is the remaining value. How to get the remaining value? There is two method. The first method is very direct. It's very direct. You use the initial value, 16.5 million, deduct the accumulated depreciation value, then you'll get the remaining. Am I right? This is the common sense. So initial cost is what? 16.5. Total depreciation value is the 12.8 million. How to get this amount? You total out this one, first year, second year, third year, fourth year and also fifth year because this is the 5 years project. When you total out all this, you will get this figure. You see? Okay, and then this is the remaining value, meaning this is the book value. Another method is what? Another method is what? You can add on the remaining 3 years. You will get the same answer lah. Okay, so normally the remaining value is 3679500. So you use the market value to deduct the book value. What you will get? Actually, there is a loss. You see, there is a loss. When you are facing the loss, meaning that the government will give you the tax exemption, will give you the tax benefit. So the tax is what? 21%. So this 21% is out from here. Okay, 0.21. So see, this is the negative, am I right? Negative, but you should know right now you have the tax gain due to loss incurred from BV from MV smaller than the BV. And then the after tax profit you will get is you using the market value deduct. Remember, always deduct the tax, but negative negative you will get the positive. So this is the final value that you will get by selling the machine. 3379695. Okay, so actually it is same lah. When you total up this one plus this one, you also get the 3379695. Yeah, if I'm not mistaken, you see. Okay, so after that you will bring down all the value, all the figure to here. This one I think is very easy, you just total up, and then this one you deduct this one because this is the cash outflow, you spend it. This one same thing, deduct this one plus this one, this one plus this one, this one plus this one plus this one plus this one, then you will get this one. Okay, the last row I want you try. I give you 1 minute, you try to get this figure, and then try to, I give you 2 minutes lah, try to get give me the MPV and IRR. This is the answer, and then this is the cost of capital given by the question. Okay, I want each of you try. I will take the attendance right now, so you guys try. Okay, the next question will be this one, more Jojo. Okay, more Jojo. So for the Mojojo, you see, the CFO of the Nano, okay, open the company confidential, okay, envelope. It contained a draft competitive bid for a contract. Normally, this is just a story. Just want to let you know. Now, actually, he asked the CFO of the Mojojo, want to supply the Duffer canvas to the Navi. So the cover memo from the Nano CEO asked the Mr. Jojo to review the bid before it was submitted. So the bid is like this. The offer is like this. He called the Nano to supply the 100,000 yards of the Duffer canvas per year for 5 years. So this is the offer that you should supply 100,000 for each year. For how many years? 5 years. So the proposed selling price was fixed at 30 per yard. So normally for this kind of the question is quite easier because the sales is already fixed. When the sales already fixed, meaning that the variable cost also already fixed. Okay, so Mr. Jojo was not usually involved in sales, but this bid was unusual in at least two respects. Okay, what are the two respects? First, if accepted by the Navi, it would commit Nano to a fixed price. So this is the first thing. You cannot adjust the selling price. This is the fixed price. So for the long-term contract, meaning within 5 years, the price of the Duffer canvas you cannot change it. Secondly, producing the Duffer canvas would require an investment of 1.5 million, meaning you need to spend the 1.5 million to purchase the machinery and also refurbish the Nanos plant in the Lumuk Perak. You look at here carefully. You see, you need to spend another 1.5 million. So basically, this is the what? This is not the NOWC. This is not the NOWC. This is the cost that you need to purchase the new machinery and also to refurbish it. Understand? Okay, so now Mr. Jojo set to work and by the end of the week had collected the following fact and also assumption. So meaning that Mr. Jojo already collect some extra information and also do his some own assumption. Do his own assumption. So the plant in the Lumuk has been built in the early 19th century and is now idle meaning you are not going to use it anymore. So the plant was fully depreciated on the Nano's book. What is the meaning of the fully depreciated? Fully depreciated meaning that there's no book value because there's no more value. That's why fully depreciated, no more value. So except for the purchase cost of land. Because land normally is what is the asset will appreciate. So see, except for the purchase cost of the land in the 2000 of the 10,000. So meaning that during that time, Mr. Jojo only spent 10,000 to buy that land, and then the land can sold for the 600,000 after 5 years. What is the meaning like after 5 years? Meaning, this is the 5 years project. At the end of the project years, you are going to sell this land. Okay, so that's the key point. Next thing, regarding the refurbishing the plant would cost you 500k. This investment would be depreciated for the tax purpose on the 10 years. So you see 10 years MACIS schedule. The rest are the 10% 18 14.4. So you see the question will provide you the rate. Okay, so the cost for the refurbishing would cost you 500k. So for this 500k, do we need to include it? Yes, you need to because you see for this you need to refurbish, you see. So this is the second respect that you have to consider lah. So this 1.5 million is what? Is the purchase the machinery and also refurbish. So right now the 500k is accounted for the refurbish. So the remaining 1 million will go to the purchasing the machinery. So sometimes the understanding is very important lah. So you see the new machinery would cost you 1 million. So you see 1 million. Okay, 1 million plus the 0.5 million. So totally there is the 1.5 million mentioned by the question over here. Next, the investment could be depreciated on the 5 years MACRS schedule. Blah blah blah. Okay, so you just follow this rate. So I think the first point, second point, third point should be no problem. Before I continue, okay. Okay, so for the fourth point is what? The refurbished plan and the new machinery would last for many years. However, listen carefully, however, the remaining market for the duffer canvas was small, meaning that after the 5 years, no more people want this item anymore. So was very small, and it was not clear that the additional order could be obtained once the Navi contract was finished. Meaning that once you already finish this new offer, you no one will promise and guarantee to you that after the 5 years you will accept another new offer. That's why the machinery was custom built and could be used only for the duffer canvas only. So you see, this is the main problem lah. You buy this machine cost you 1 million, and then you also do for the refurbish. So uh, but this is only a specially designed for the duffer canvas, you see. So its second hand value at the end of the 5 years is probably zero. No one want to use that anymore, because who want to buy from you? I buy from you, but I already know the remaining market for the duffer canvas in the future is very small. So what is the purpose I want to buy the machine from you? That's why this is the assumption done by the Mojojo. The second hand value at the end of the project year is probably zero. So meaning that this is the salvage value. You get what I mean? This is the salvage value. I repeat again, this is the salvage value. Okay? Or maybe this is the market value. So for sure this is not the book value. Book value you need to calculate it. So cost of goods sold include the fixed cost 300 per years. Okay, this is the fixed cost plus the variable cost. Variable cost is the 18 per year. 18 per year. And then costs are expected to increase at the inflation rate of the 4% per year. So you see, the cost is expected to increase by the 4%. Okay, but the fixed cost is what? Remember, even though it's fixed cost, but the question already mentioned the
Sorry,
cost. Yes.
but the meeting is going to end soon.
Sorry, sister. What are you saying?
The meeting is going to end.
Yeah. I also noticed that. Later, I will share a new link with you, so you just rejoin it. Okay? Are you listening? Can I? I will reshare. I will reshare you with a new link. So you see, the cost. The question already mentioned all the costs, including the fixed cost, also increasing by the 4%. So sometimes you have to evaluate the question very carefully. So the initial, remember, is by the 4%. Jot it down, because later on I will show you the answer. So the initial investment, okay, wait, okay, I think everyone already joined. So we continue. The initial net working capital is what? Is equal to the 300k, 300,000, and it is assumed fully recover at the end of the project. So this is very easy. At the end, at the term at in the terminal cash flow, you just need to add another 300 cash inflow. That's all. So you see, okay, the last part, the arms with his information, Mr. Jojo construct a spreadsheet to calculate the NPV and also the IRR lah. Then you need to determine is it you want to accept it or not. So he had just finished debugging the spreadsheet when another confidential envelope arrived from the Nano CEO. It contained a firm offer from a Tanjung Malim real estate developer to purchase the Nano's Lumut land and plan for 1.5 million. Okay, meaning that this what uh you see this is the land and also the what, where is it the land and also the plant, but the Mr. Jojo already debugging. Okay, meaning already I refuse this offer. So later I will explain to you is it we need to include this 1.5 million or not. So the last one, should should the Mr. Jojo recommend submitting the bid to the Navy at the proposed price of 30 $30 $30 per yard. This discount rate for this project is 12%. So this is the what discount rate. This is not the IRR. You need to make sure the IRR is more than the 12%, and then 35% is the tax rate. Okay, so right now we will go to the. Okay, so I strongly believe that each of you can see my screen clearly. So I will go to step by step. Okay, you see for the Mojojo, so you do the same thing. You list down all the years, and then okay, so there is three components in the year zero, meaning this is the cash outflow. So the first one is the machine. Just now already mentioned in the question is the machine will cost you 1 million, and then another 500,000 is what is the refurbishment. So I think this one is very clear. And the last one is the NOWC. So this NOWC just now I already mentioned is the what 300,000. 300,000. Okay, so settle. Next, you go to the sales revenue. Okay, I'll put the yellow color lah. Okay, now you go to the this sales revenue. So how to get the sales revenue? I already mentioned the sales is what is 100k, right? Did I show over here? No, I didn't show. The sales is 100k for each of the year, and then for each yard, the selling price is the fixed price. The fixed price is $30. So you use the $30 multiple with the 100k, so you will get the 3 million for each of the year. Remember, fixed sales unit and also fixed the selling price. Next, the variable cost is the VC. So remember the how you get the variable cost. You get the variable cost is what? 18 ringgit. Sorry, it's not the ringgit. $18 multiple with the 100k. Remember, VC is the VC per unit. Okay, variable cost per unit. So you use the 18 multiple with the 100. Then you will get the 18,000. I think it's 1.5 million. 1.8 million. Sorry, 1.8 million. So remember, the cost is expected to increase by 4%. So you see, for the next year, you will get the use this column, this column and this bracket answer, which is the 1.5 million. You multiply with the 1.04. Okay, you should know why it's 1.04 because it is increasing. If you multiply by 1, just 1. But it's 1.04 meaning increased by 4%. I normally will teach this method to my student. Okay, change it into the decimal places. Okay, once you get this, you do the same thing for the remaining one. Okay, for the third year, you use the second year VC multiple with the 1.04, and then you do continue. Okay, I think this one is easier for you. So the fixed cost, even though it's fixed cost, but the question already mentioned the fixed cost will is also expected to be increased due to the inflation. So you see, 4%, 4%, 4%. So do the same thing. Next, depreciation. Yeah, okay. So for here we have the both item. Remember, initially is the refurbishment. The second one is the machine. So we go to the refurbish first lah. Refurbishment is what? The value of the refurbishment is 500k. So you come here. Where is the refurbishment? Okay, refurbishment is we are going using the 10 years. 10 years MACRS. Okay, 10 years MACRS. So you see, the question already give you in the percentage form, but normally I will ask you to change it into the decimal, divide by 100. So you see, 500k, same thing, but you are going to calculate up to the year 5 only, up to the fifth year, fifth year. So for the first year, depreciation value will be 50,000. So you do the same thing lah, just the same thing. Okay, you can try it later on. Okay, as you watch this recording back. Okay, so the last year is around 46,000, 46,000. So you see, sorry, it's over here. So I think this one is okay for you. Next we go to the depreciation of the machine. Okay, how to get? Same thing, you do the same thing. Okay, this is the 5 years, 5 years MACIS. 5 years are different. Just now the refurbishment is the 10 years. So for the machine up to the 6th year, but our project useful life is only 5 years. So you only need to calculate up to here. So you see, I write the book value over here, meaning that this 57,000 is the book value for the machine, and then this is the book value for the refurbishment. So same thing, 20,000 up to the 11.5 thousand. Sorry, is 2 million up to the 1.1 million, and then you just put the figure up here. Okay, so next thing you will get the EBIT. You use the sales revenue, deduct, and then you will get the EBIT. So you should get the same answer. I mean same answer meaning you are using the same formula like me. Okay, you see, use the upper one, deduct the lower one. Next, regarding the tax, this is very easy lah. 35% out of the 6.5 million. Okay, sorry, it's not the 6.5 million. 35% out of the 650 100,000. 650,000. Okay, then you should get the same answer like me. 35%, 35%, 35%. Next, you will get the earning after tax or maybe profit after tax. So this is the answer. You use the 650 to deduct the 227, and then you will get the 422. Same thing, do the same thing for each year. So remember, you have to add back the depreciation value of the machine and also refurbishment. See, this one settle, you take from this one. Next, you put here green color. Yeah. So lastly, you will get the what? Annual operating cash flow. I repeat again, you will get the annual operating cash flow. This one should be okay. So next, okay, you just add back you just add the depreciation value of the machine and also the depreciation value for the refurbishment. Then you should get the 672.500. You do the same thing for each of the year. Why the figure will be different? The reason is due to the expected increase of the variable cost and also fixed cost. Okay, I continue. Now, NWC recovery, okay, net working capital recovery is already mentioned, fully recover, mentioned by the question, mentioned in the question. So you just put this 300k in the last year, and then now you have three things. You have three things. This land self salvage value just now already mentioned by the question is 600 600,000 600,000. Okay, 600,000. So you see, you go to the land, you put the what? You put the salvage value is what? 600,000, and then you get the tax gain or tax loss. So you see, book value of the land is what? Is 10,000. Already mentioned by the question. Okay, 10,000. Okay, if you looking back when I think I need to show you. Hmm, wait. Okay, you see where is it where is it, sorry, over here. ah you see, the purchase of the land is 10,000. So basically this is the book value lah, the original value. Okay, maybe you are confused. How we are going to determine this 10,000 is the book value? Remember, land is different from other asset. Land is the asset that can appreciable. You get what I mean? Land is different from the equipment, refurbishment, blah blah blah. All that thing is the depreciable asset. But for the land is the appreciable asset. So normally when you buy it for how much, normally that is the book value. Okay, normally that is the book value. So we go back to the question. So see, 10. So when you use the market value deduct the book value, you will realize, hey, you already gain. You gain how much? You gain 590,000. So from this gain, you need to pay the tax lah, because you are gain. Then you are going to facing the tax loss because you need to pay the tax, because now there is a capital gain for you. Okay, so the tax is 35% out of the 590,000. So this is the amount. Okay, so you use this amount to deduct the tax lah. You will get the after tax proceed. So normally I will put here, I will put the salvage value for the land, and then put the tax loss 35%. So it's very easy. You will get the same answer. I show you over here. This equal this minus 206 point.
Hello?
Yes. Hello.
Forgot screen.
Yes. Speak.
You forgot to share screen.
Sorry. Luckily you remind me. Sorry. Mojojo. Okay. Can you see my screen? Can I? Okay. I continue. So basically, this answer is using this market value deduct the tax loss. Remember why you need to pay the tax? Because you already gained from here 590,000, because you are using the 600 market value of the land to deduct the book value of the land. Okay, to deduct the book value of the land. Remember, the like what I mentioned just now is the land is the appreciable asset. So whatever the price you pay for it, that is the book value. So when you having the gain, you need to pay the tax because you already have the capital gain. Then you need to pay the tax to the government. So the total amount of the tax you have to pay is the 20, 200 and how much? 2 million something. Is it 2 million? I don't think so. It's 206,000, 265,000. Okay, 6,500 something like that. So this figure, so you can use this amount market value to deduct the tax you have to pay. Sorry, then you will get sorry, wait. You use the book value. Wait, I think I put here book value, sorry, market value to deduct the total tax. So this is the after tax proceed from the land. So do the same thing from here. You use this 600,000 to deduct the tax. That's why I put the negative. Okay, that's why I put the negative because this is the cash outflow. You pay for the government. Okay, next you go to the salvage value of the machine. Do you have any salvage value? I don't think so, because no one will buy the machine from you. And then during that time, the machine is especially designed for you to produce the duffer canvas. That's why it cannot use for other market anymore. You get what I mean? That's why there's no more value, no more value. So the salvage value is zero. Okay, and then the tax gain is what? Since you already lost. Okay, how can I say you are lost? You see, the machine the book value is what? You still have the 57 something, 57 something. How to get the book value? You come to here. This is the machine. You see, first year, second year, third year, fourth year, fifth year. So after all these, all the depreciable value, you will get the remaining 57,600. This is the book value for the machine. So you will get a loss. Okay, when you get the loss, you will have you no need to pay the tax now, meaning you have the tax gain. So this amount actually, even though I show you in the negative because you already lost, but for you not to pay the tax, meaning this is the cash inflow. This is the money you will get. Okay, the opposite way lah, because you already capital loss. Am I right? Okay, the next thing. Remember, refurbishment is go together with the machine. If machine cannot do anything, then the refurbishment also cannot do anything. Remember, you cannot sell it. Okay, so for the refurbishment, you do the same thing like the machine. You see the market value is zero, and then the book value of the refurbishment, this is the total amount. See, this is the total amount. So total amount is here. You get the remaining amount. Okay, up to here, and then you will get the 184,000 and 300. Okay, so this is the loss lah, meaning you already lost because you use the market value to deduct this book value. Then you will get the negative figure. Then negative figure you will get the tax gain, meaning that you no need to pay the tax. This is the meaning of the tax gain, tax benefit. So this also another cash inflow, another cash inflow. So lastly, you do the same thing now. You bring down all the way. Okay, you bring down all the figure over here. Okay, you bring down, and then the last one is very easy. You use the first blue color, you plus, deduct, plus, and then you will get this figure. Okay, so lastly, the cost of capital is 12%, and then for the NPV and IRR, I want each of you try to get the answer right now. Okay, okay, now try so I assume each of you get the correct answer. Can. Okay, So before I go to the MCQ question, if there any question regarding these two capital budgeting. Okay, I assume no. So basically we will have a 1 minute break. Okay, 1 minute break. After the break, we will go to the last part is the MCQ. I will share the question in my screen lah. Okay. Okay, so we are going to the last part of today's class. Okay, so basically this is the MCQ question, but it is tough, it's more difficult. Normally in your final exam, this is the what? This is the example of the question lah. Okay, can you guys see my screen? Can or cannot?
Can.
Can okay. So you see, we have the two different project. Project N has the IRR of the 15%. So normally you have to understand this is the return for the project A. And then the project B, the IRR is more higher, is more higher. But you cannot always say that the project with the higher IRR is always the better one. No, later I will explain to you. Both projects have the same risk. You see, now the risk is the same. So normally as an investor, you should go for a higher IRR. So which of the following statement is the most correct? So we go to the first one. The first one is if the WACC is the 10%. You see, if the WACC is 10%, meaning actually both of the project we are asset. Both project will have a positive NPV. Am I right? See, positive NPV for sure because the IRR is higher than the 10%, and then the NPV of the project B will higher or exceed the NPV of the project A. You cannot say like that because you need to calculate it based on the expected cash flow. You get what I mean? That's why actually there's one more part I want to teach you guys, but don't worry, in the future I will teach you the graph of the NPV. This one, project A, and then maybe I use the different color. This is the project B. So let's say the intersection point here, let's say I just give you a let's say 10%. So you see, the question is mentioning that, and then the NPV of the project B always will what? Will exceed the NPV of the project A, meaning that the NPV of the project B always higher than the project A. You cannot say like that. You get what I mean? Because sometimes this is the project A, this is the project B. You see, before the 10% project A is better than the project B, but after this certain point, the project B is better than the project A. So you cannot say like that. Don't worry, this graph I will teach you. Okay, before the final exam. Next, if the WACC is what? If the WACC is 15%, the NPV of the project B will exceed the NPV of the project A. So for sure, this is the most correct one because why? You see, when the WACC already 15, so we already know that this is the maximum return for the project A. But the project B, we will have a higher IRR. Am I right? So the NPV of the project B will higher than the project A. I think this one is the common sense because when the IRR equal to the what? Equal to the WACC, meaning that your NPV will equal to 0. This is the common sense one. No gain, no gain, no loss. This is the break even. But you see the IRR for the project B is higher than the NPV. Sorry, is higher than the WACC. So meaning that the NPV is higher than the 0. So for sure it's better than the project A. I think this one is very clear for you. And also for the CDE also is incorrect lah because it's you see if the WACC is less than 18, project B will always have a shorter. You cannot like estimate just like this the payback period. So regarding the payback period, you just cancel it off because for the payback period, remember I have told you is what the liquidity here. Do you have any cash flow? No, that's why no need to consider it. And also the last one, if the WSCC increase, the IRR of the both project will decline. Okay, not really decline lah. Okay, you can also like that. Next, you see, normal project C and D, okay, are mutually exclusive. Project C has a higher NPV value if the WSCC is less than 12. What is that meaning? Meaning that the 12% is like the center point. Meaning that before the 12%, the project C has a higher NPV. Okay, I think I need to draw for you. Okay, red color is the C lah. Okay, C has a higher. Then orange color is the D. So meaning that before 12%, the red color is the C, right? C has the higher one. C. This is the D. See, higher than. This is the NPV. And then below one is the IRR. So you see, before the 12%, the NPV of the C is higher than D. This is what the what mentioned by the question. So whereas the project D has a higher NPV if the WACC is exceed is more than 12. So make sense lah. So this is making sense. You get what I mean? The D, the NPV of the D is higher than the C after the 12% of the WACC. So which of the following statement is the most correct one? So the answer actually is the A. Project D has a higher IRR. What is the meaning like that has a higher internal rate of return? Meaning that why the what the IRR of the project D is higher than the C? We can know because of as actually this is the IRR. Yes, this is IRR and also NPV. But if we talking about the WSCC, as the WSCC keep increasing, but you see the what the project C performance of the project C is what is declining. So from this point we can understand, we can know that actually the IRR of the IRR of the project D is higher than the project C because as the WSCC increasing, you see from the 12, 13, 14, 15, the NPV of the project D is above the NPV of the project C. So I think this one is very clear. So the answer is the project D has a higher IRR. Okay, so for the B, I think project D is probably larger in scale than you do know. Project C probably has a faster CAC. Okay, I already mentioned many times. For the payback, that one we need to depend on the cash flow. And then the statement A and C are correct. Cannot. I already said C is wrong. So all of the statement above are correct. So cannot lah. Cannot be the answer. So I continue. This one is very simple to evaluate your understanding. So you see, the IRR is what? The IRR is 11.63. The PI ratio is 1.04. So you have to understand, if the PI ratio already more than 1, meaning you already profit, and then the IRR should be higher than the WACC. This is the common sense. And then the net present value is positive. Because if okay, let's say the question didn't give you the WACC, but if you notice that the profitability ratio already more than 1, meaning that you already earn, and then the NPV should also give you bigger than 0, and then the IRR is what? IRR, for sure you have to understand the IRR is bigger than the WACC. So maybe the WACC is 11 or maybe 11.5. The WACC cannot higher than the IRR because the information given to you is the PI ratio already more than 1. So which of the following statement is correct by given from the given information? The discount rate used in computing the NPV value will less than 11.63. So this is the answer lah. Discount rate I already mentioned many times. Discount rate is the what? Discount rate is the WACC. So the WACC will be less than 11.63. Computing the NPV. Remember, just now what you have learned, you use the cost of capital as a discounted rate to get the NPV. Next, the discounted payback period must be less than 2.98. You cannot know. You don't know. You get what I mean? Okay. The next, the discount rate used in the computation of the PI ratio was 11.63. Wrong. Must lower than it. So second and third already wrong lah. So the project should be accepted as the IRR. IRR is this one higher than the WACC. Yes, this is the answer. So the answer is B, 1 and 4. Okay, 1 and 4. So see, all the insurance firms agree to pay the years. Okay, to pay each year. Three to pay you 3,310. So agree to pay you lah. And at the end of the 20 years, if you pay the premium of the $100 per year at the end of the each year for the 20 years. So meaning that if you I'm the insurance company, like you buy an insurance lah, I agree to pay you 3,000 something at the end of the 20 years. But before this, you have to pay the premium lah at the end of the each year. It's not the beginning so you not need to change anything. So find the IRR of the return to the nearest whole percentage point. So how to calculate it? You need to take out your financial calculator. You insert the n equal to 20 because it's 20 years. Okay. And then you put the FV. FV is how much? 3310. Okay, 3310. And then what is the PMT? PMT payment is what? Each of the year you pay for the 100. So you put the negative 100 as the PMT. And then n equal to 20. Okay, and then what is the future value? Future value is 3310. Am I right? But remember, 3310 is the total inflow. But at the end of the year, you have to deduct 100 because on that year you also need to pay 100. So actually 3310 deduct the 100 you pay during that year. So the future value is 3210. So you should get something is the 4.7 lah. So if you use the nearest one, the answer should be 5%. I want each of you try first. Okay, I hope each of you get the answer. The answer is 5%. Okay, next. Okay, this one I think is the cash flow that you have done before this lah. So you have two projects, Team A and also Team B. Team A, the cash flow for each of the year, and also the cash flow from the Team B for each of the year. So at what discount rate would be the indifference between the two contracts? What is the meaning like would be the indifferent point? Meaning that indifferent is meaning that both of them you will get at that certain point you will get the same return. That's the meaning like the indifferent. Because if you choose A, it will also give you the same return. If you choose B, it will also give you the same return. That's the meaning of the indifferent. You can choose either one because both of them will give you the same answer. So how to get this one? You need to get the difference between them. That's the first way. So if you use the team A to deduct the team B, so you follow each of them. So you use the add to deduct the 2.5, you will get the 5.5. 4 deduct by 4, you will get the 0. 4 deduct by 4, you will get the 0. And then 4 deduct by the 8, you will get the negative 4. 4 million, normally this is the million, deduct by the 8 million, you will get the negative 4 million. So you insert all this into your cash flow. You using the financial calculator. So you type in the 5.5 million as the CF0. You do the same thing until the CF4. So 0, 0, negative 4, negative 4. This is the CF1, CF2, CF3. Okay, you insert it. Okay, you insert it. And then you should get something, after you get this one, you should get the 11.35. Okay, how to do that? You follow my step. You key in the 5.5. Okay, positive 5.5, and then put the 0 CF1, put the 0 CF2, and then put the negative 4 CF3, and then another one negative 4 CF4, and then you click on the IRR, you will get the 11.35. You click the orange color, shift down, and then go to find a symbol, it writes CST, below it return IRR. Then you should get 11.35. Okay, 11.35. If there is no question, I continue to the last question. So the last question is what? Same thing. Project A and also Project B. Project A and also Project B. Don't worry, for the MCQ question, later I will send into the WhatsApp group to each of you. So for the last one, I will go through it. So when is the project A is more lucrative, meaning more profit than the project A? Meaning when you see this kind of the question is asking you at which point the project A, the project B will has a higher NPV as compared to the project A. Meaning B is better than A when we comparing the NPV. The higher the NPV, the better the project. Okay. So over what range of the cost of capital, okay, does the project B has a higher NPV than the project A? Choose the best answer. So same thing, you need to give me the what? This thing I will normally I want to leave this question in the future lah. For this question so far, because there's no time for me to do a long explanation, but this is a quite long question. You can have a look first, but this is quite difficult. Maybe on the next class I will do a fully explanation for this question. Then I will go to the WNCC. Okay. Okay lah. Because I think right now you guys also already very low energy. So for this question I will explain to you on the next class. Okay, so basically that's all for today class lah.